Where'd they get that picture from? That's not me.
All right. Hi, everyone. For those that don't know who I am, my name is James Seyfert. I'm a research analyst at Bloomberg in our Bloomberg Intelligence Department. Primarily cover the asset management industry. I do tend to write a lot about passive flows. Me and Mike argue a lot on Instant Bloomberg. So we're going to get into that today. Why don't you guys just give a quick background on who you are and what you do with passive and ETFs, and then we'll dive into the topic of the day.
Sure. So Mike Green, I'm the chief strategist and portfolio manager for Simplify Asset Management. We're about an $11 billion ETF firm that came into being in 2020 with a change called the derivative rule that facilitated the inclusion of option and derivative and leveraged strategies within ETFs. We primarily offer alternatives, fixed income, and various forms of modifying beta exposures.
Hi, everyone. Dave Abner. I run the mutual fund and ETF businesses for Northern Trust Asset Management. I've been around here for a long time. I started out as an ETF trader at Bear Stearns many years ago, traded with guys like that guy sitting there. Many, many moons ago, I spent about 12 years at Wisdom Tree, and I joined Northern about almost 2 years ago.
All right, great. I think there's a lot of people here that think we're going to disagree a lot, which we do disagree on a lot of the finer points, but for the most part, I think we tend to agree on the high-level points. But before we get in, let's define passive management. This is one of those things where I think, like, if you don't actually discuss what you're talking about when you say passive, there's going to be some disagreement here. So let's go to you first, Dave. Like, how would you define passive management or passive flows?
You know, look, I think it's really hard. I think, like people think about like the S&P as being a passive index, right? But the investment committee on even that index makes active choices on what's going to be included. So you could go back sort of to the beginning of indexing time and think everything was passive, but it's not so clear. And I think this is the way the sort of industry has moved, right? We used to consider mutual funds in the sort of old days. Mutual funds were sort of active, and then there were mutual funds that tracked an index, and they were considered passive, right? But if you think about it, like indexing has changed, the industry evolved, and indexes are really no longer passive. Like at Northern, we have a quality low vol index fund. I mean, if you think that index is passive, then you know I've got a bridge downtown we can talk about as well. So I actually think it's sort of blurred the lines, and I'm not sure. It gets confused with another piece of the business that we talk about a lot, which is when you launch an ETF, you're forced to declare whether the ETF will track an index or not track an index. And if it's not tracking an index, it's called passive. We'll probably talk about it, right? And so we talk a lot about active and passive in terms of how you stipulated the ETF, and not whether the index it's tracking is actually active or passive. So it really has blurred the lines on what's going on here.
Yeah, I mean, I view it as a spectrum. I think, like, you know, the S&P value or Russell 2000 value and things like that, they're considered passive in our system, but you can make the argument that they're active. And you said S&P 500. I think there's 50 plus names in the S&P 500 that wouldn't qualify to be added today. And at last reconstitution, there was like 25 to 30 names that could have been added that were more apt to be added to the index that weren't. So pretty active. Mike, I know you have a very thought out, specific definition of passive and how there is no passive, but I'd love to hear it from the horse's mouth.
Yeah, I'm glad we think of it from that direction. The academic definition of passive is somebody who always holds every security in proportion to its market capitalization. The problem with that academic definition is it leaves no room to get in, and it also leaves no room to get out. And so the real breakthrough in terms of understanding how passive impacts markets occurred in 2016 when Lasse Peterson identified that on index reconstitution, passive investors were forced to trade. My contribution to that was to recognize that every single day they receive inflows and outflows, and so they trade on a continuous basis. Therefore, there is no passive investing per se. But for the purposes of the conversation, I treat largely the market cap weighted broad exposure indices as what we're talking about when we talk about passive. The rest of the use of indexes is really just marketing, right? It's an official mechanism by which you can get a blessed back test put into the public market.
All right, so let's get into the name of the actual panel. Dave, are passive flows distorting markets?
I didn't even know I was on this panel until yesterday. Look, I'm going to take the negative here, right? So I actually think that market structure has changed dramatically, and even beyond market structure, the way people invest has changed dramatically. Like we've been talking about derivatives-based funds, and I think it was Will mentioned the sort of increase in direct investors into funds. So I think it's not that, from my own personal view, and it's more subjective than anything else, or objective. I think passive flows are not really distorting markets. I think market structure has changed dramatically, and that's what people are latching onto as being like this concept of the markets are broken or they're distorted from passive flows. I just don't think that's true.
Mike, are passive flows distorting markets?
Well, I'm actually intrigued. Do you want to go back and talk about that bridge at Lower East Side? I'm worried that crosses over into my credit work.
I'm a good sales guy.
Yeah, no, I think you've double pledged the collateral, though. I mean, look, I think passive is actually distorting markets to a degree that almost is unimaginable, right? So I'm actually just about to release a paper that mechanically actually breaks it down, and some of the numbers are really astonishing, right? So about 20% a year for Apple in terms of annual return is now being driven by the distortion of passive. That sounds absolutely insane, right? It would suggest that the proper valuation of Apple is about $100 as compared to its current level of around 280, 265, I think it is. That feels unimaginable, but unfortunately it's empirically demonstrable. Right? And so what we know is that the process of not actually being passive, but of being a systematic strategy that relies on the process of simply saying, did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. That's the rules of the systematic strategy. What should I buy? I should buy things in proportion to their market capitalization. That means I am piling unbelievable quantities of flow on an order basis into companies like Apple or NVIDIA or Microsoft that is actually causing the price to rise in the process of that flow. And because it does not have any check of valuation associated with it, the next dollar in will buy even more of something that has been pushed up. And that mechanical property is really what is the focus of my work.
So I mean, this kind of gets to something that's been pretty big in academic finance circles since I really, well, we'll say over the last less than a decade or so. It's kind of this move away from CAPM models to more stock to flow, flows over pros, supply demand type of analysis of securities. Could you go into what? First of all, I will say those numbers sound insane to me as well, what you just said. So I mean, when I look at it, I look at if you just look at the Mag 7, theoretically the idea is this is distorting markets at the top of the. But we see massive divergences in performance. So I go back to the eye test part of this, where if that's really happening, then they should all be going up in the same way, in the same regard, not responding to idiosyncratic risk. So I guess two things. One, can you talk about the CAPM versus flows over pros things, and then also the eye test to markets?
Sure. So the entire theory of the CAPM, et cetera, is built on the idea that it's information that matters. That ultimately you're trying to provide a discount rate with capital asset pricing model that you then are applying against a forecast of cash flows to reverse engineer into a discounted cash flow. It's supposed to capture the risk factors in the weighted average cost of capital analysis, and you're supposed to use that. Nobody actually does that anymore, right? I mean, the simple analysis is that if you are buying the S&P 500, you are not thinking about what is the appropriate value for Apple. You're simply putting money to work into a broad index under the expectation that the index itself is going to magically deliver the returns that it historically has delivered. The behavior of individual stocks is absolutely influenced by individual discretionary managers, noise traders, et cetera. And actually, one of the more interesting byproducts of my work is seeing how radically we have decreased the quantity of trading that is tied to the traditional active management space. If you go back to 1995, about 80% of trading activity was derived from the active management space, mutual fund managers, hedge fund managers, et cetera, that would be trading securities that they had selected, built a discounted cash flow model for, et cetera. Today, that number is down around 10%, right? Back in 1995, about 10% of the market was retail speculative trading. Today, it's about 20%. Right? So they are now double the size of the active management space in terms of their trading activity. That's a combination of the reduction of commissions. It's a combination of the introduction of free trading, commissionless options paid for through payment by order flow. All of these factors have driven a dramatic increase, and so in just pure academic speak, the noise traders are now twice the size of the active manager space.
Can I hop in with a
I was
question
going to say,
there?
it sounds like the market structure comment you were talking about, Dave.
Yeah, like, so you mentioned this comment about the mutual fund portfolio managers has decreased dramatically. Does that take into account the growth of like the people in this room who I consider to be the new active managers in a way? Like, and they've really changed, the industry has changed from managing a single portfolio to managing portfolios of funds directly for clients. It's different, but is it definitely smaller?
It is definitely smaller. The claim about the growth of actively managed ETFs in particular is candidly seized by the proponents of passive investing as probably their single best defense.
But what about the managers of ETFs?
You're talking about using
ETFs?
passive ETFs actively. You're talking about advisors using passive ETFs.
I'm talking about this is a room of asset allocators, right? Yeah. Like that's who's here. And are we accounting for what they're doing in these numbers in terms of the decline of portfolio managers running mutual funds?
We are, because the way that we actually are calculating the level of passive is not simply adding up the quantity of shares that are held by Vanguard, BlackRock, State Street, et cetera. The gold standard in terms of deriving this is actually using things like events like index rebalancing to track what percentage of shares actually change hands on those events. And so now we're actually able to track the origin of where those are occurring, not just where how they are labeled, whether they're labeled passive or active. And the number works out to be about 53% of the market is now passively held.
Interesting.
Yeah, we do look at the numbers of actual shares that are owned, which is different from the analysis you just spoke about. And you can look at this, you can look at the indices, and you can see individual stocks for the most part. It's trending up and to the right for passive management. Ironically, it didn't start trending down for active ownership as a percentage of the shares outstanding until like 2018 time range, really, for the most part. It was actually still trending upwards, and now you literally have these intersecting lines of like the average stock's passive ownership versus active ownership, as measured by mutual funds and ETFs only. There are going in divergent directions.
Well, you highlighted that the research has really only recently begun to emerge that allows us to think about how flows impact markets, right? And the really critical work is done by Ralph Koijin, and I'm forgetting Hugo's first name, and then that was enhanced by a paper by Gabay and Koijin in 2021 called the inelastic market hypothesis. Just to give you some idea of how messed up our models of how markets used to work, when I started doing my research on the impact of passive, there was actually no real understanding of the shape of supply and demand curves in secondary markets for securities, what caused investors to buy them, what caused investors to sell them. There was simply a hypothetical information-based framework in which we were in the pursuit of returns through better information. My work actually suggests that the historical mean reversion characteristics of the market is a byproduct of managers actually caring about valuation. Because what that means is if price rises without fundamentals rising, your expected forward return is lower. That means you have a higher propensity to sell on valuation increases and a higher propensity to buy or hold on valuation decreases. That actually creates a mean reverting market framework. When you introduce passive, because passive has 100% marginal propensity to buy, and it actually has a bias towards buying more of what has gone up, it actually inverts it. In economics, it creates what's called an upward sloping demand curve. We effectively have turned stocks into status symbols like Veblen goods that we desperately have to have, and the ones that we most desperately have to have in our portfolios are the mega caps.
So you talk about the inelasticity. I mean, most people would argue like $1 or $100 going into a stock is going to move it by more than like the actual dollar going in. I think is kind of what you were getting at. What is that rate? What is your academics research show that number actually is?
So the calibration of this under the efficient market hypothesis is basically the bid-ask spread. So $1 into the market creates about a penny of additional market cap. What we know now from the work of Gabay and Koijin is as of 2021, that number was between $5 and $8, right? So misspecified 500 to 800 to 1. My work, which continues to update that, now suggests that that number is around 12. All right, so we're creating about $12 of market cap for each dollar that we're contributing to the stock market. That suggests that any framework that begins with the EMH, which again assumes that markets are nearly perfectly elastic, is just going to be horribly flawed.
Dave, before I go on, do you have any thoughts?
I wonder what this means with like the way you portray it. It sounds like the end of all bear markets.
Well, there is definitely a component of that, right? But unfortunately, when you think about it as an entire system, contributions are always going to be a function of incomes, and withdrawals are always going to be a function of asset levels. This is why the historical Buffett indicator of market cap to GDP works. You're proxying asset value versus income levels. The fact that we've exceeded that tells you that we have some form of loading factor or forcing in physics terms that is actually pushing it beyond that. I would argue that that's actually what's happening with passive, but it doesn't end the underlying characteristic. You can imagine a scenario in which a Shiller PE went to 500, and at that point the contributions coming in from incomes would be extraordinarily small, and the withdrawals would exceed that. If that takes the form of passive selling, unfortunately, we have no idea where the buyer is.
So, I mean, let's just say you're right? Everything is being completely distorted by passive. I guess that would be your argument for the negatives of what passive investing has done. Let's just accept that. But like some of the positives are hundreds of billions of dollars in fees that were not passed on from active managers over the prior decades, probably helped give rise to passive.
No, I'm joking.
and investors, right?
Yep.
So there are some benefits to basically being able to get free beta to varying different beta, depending on how you want to describe it. Whether it's the S&P 500, small caps, there you can get them for single-digit basis points. So there are benefits to that. My question is, like, how do you weigh those pros and cons? And also, like, what is the solution here? Like, do you just outlaw passive investing? Do you cap it in some way?
So, this is one of the challenges, right? When you're a critic of passive, it's presumed that you just hate the entire idea.
Well, you work for a company.
I work for an ETF firm,
ETFs,
right?
Yeah.
So first of all, not all the ETFs are passive, right? The funds that I manage are active, even though we actually perversely obtain exposure through a index-derived approach. The answer is actually unfortunate that we need to recognize that there are benefits associated with passive investing, and primarily the low cost and theoretical, the ability to obtain diversification benefits. And actually, my work suggests that there is a critical threshold at which passive, until you exceed that point, is a huge positive contributor to market behavior. It's simply introducing, when you first introduce passive, right, you're actually introducing a new form of algorithm that increases the heterogeneity of the reasons why people might buy and sell. It facilitates liquidity, it lowers volatility. It's only once it passes that critical threshold that it ultimately becomes a problem. And candidly, the proposals that I have floated to regulators is that we should limit exposure to passive to those who actually need it, those who do not have the capacity for education, particularly those in 401ks and in other areas in which we shouldn't expect them to be doing securities analysis in order to secure their retirement. And so what I would actually propose is that there is effectively a means test associated with it in which many of the benefits of passive actually then get pushed back. I like to highlight, Warren Buffett has said that he's putting his ex-wife or wife's, bequest into passive vehicles because he doesn't want her taken advantage of by Wall Street salesmen. Right? The simple reality is this is a woman who's going to have a $50 billion trust. Like, I'm sorry. One, she should be taken advantage of. But two, the reality is if you have $50 billion, you have a responsibility to society to actually be thoughtful about how you're allocating your capital.
But it is being thoughtful if she thinks passive is distorting the market in her favor to buy more passive.
Actually, that would fall under securities manipulation.
For some, right? Not for all.
That's part of the problem, and I unfortunately would argue that many of the challenges that we experience in our society today are a byproduct of our decision from a policy standpoint to build our retirement system this way. Right? If you're going to retire and you're going to build your retirement base on the idea of equities, what's the right answer to how much you should have? The answer is always more, right? Because you can always be taken for a significant loss. You need to have more. And so one of the challenges is that we've created a retirement system that is built on effectively accumulating resources that raises the price of those resources and makes them less attainable to the younger generation. It also perversely means that retirees spend far less than they actually should, which lowers incomes for the next generation. We also have chosen to bless a particular type of investment for those retirements, primarily large multinational publicly traded equities. Right? That means the capital that would be invested elsewhere and in a society in which we did not provide both liability protection and tax advantages for that style of investing would be directed to other parts of our economy, like small business investment, et cetera. So we've built a pickle for ourselves primarily by imagining that we can use policy diktat to convert a market that is designed to price the marginal cost of capital and turn it into a retirement utility.
You talked about a critical level. Like where is that critical level? Like how big of the market does it have to be passive before you think we pass a critical level? You said we're at by your estimations, it's 53%.
Yeah, so there's a couple of things that feed into that. And again, this is unfortunately very new work that has not yet been published. But it actually turns out that there's two vectors that influence that. One is that the quantity of passive effectively shrinks. It's one minus the share of passive that shrinks the quantity of other players that can influence prices in a meaningful way, right? So when you ask who's there to buy from passive, well, if passive gets to 99%, there's nobody else who can possibly buy. A 1% redemption from passive would overwhelm any capacity for the market to actually meet that redemption. The second component is John Bogle has famously said, we could get to 75%, although interestingly enough, when he began this work, he ultimately hypothesized that it would only be about 20% of the market would ever be passively managed, right? We're far in excess of that. He argued it was around 75%. That actually treats the stock as the single most important component. The problem is, as you transition from 50% to 75%, more than 100% of your marginal flows are actually passive. And that's a condition that has been in place really since about 2016. So again, if you put on your physicist hat and you think about the idea of a loading or a forcing factor, right? You're adding amplitude to it. If you have outflows coming from active managers who traditionally think of the world from a value framework, you now have a negative loading on the value factor, right? You have a positive loading on the momentum factor. And unfortunately, this is exactly what we've seen over the last decade. Momentum strategies have outperformed value strategies by an unimaginable amount. The second factor is actually concentration. So concentration is both a byproduct of passive and it is a contributor to lowering that threshold. The more concentrated the market becomes, the more distortive the flows become for the largest companies. I actually think we've clearly passed that threshold at this point. At today's level of concentration, my math suggests that it's only about 20% passive before it becomes a real problem.
Okay, so your solution sounds like a policy solution.
Unfortunately, it has to be, right? We got here with a policy choice. In 2006, we changed the retirement systems in the United States with the Pension Protection Act. We moved from what was called an opt-in system where you had to choose to participate in a 401k. And if you remember at that time, you'd open up your 401k package and there'd be about 3,000 mutual funds that you'd have to pick from, right? We used to sell 401k programs on their extensiveness. Well, all of those were all types of different active managers and passive managers, and the pool was open to all of them. In 2006, with the Pension Protection Act, which was part of George Bush's ownership society, which also contributed to the housing market collapse in 2007 because of the mortgage component to it. We changed it from an opt-in framework to an opt-out framework. You had to choose not to participate. And when you do that, you then have to select a vehicle that is the qualified default investment alternative that provides unique benefits for the sponsor of the 401k, in which there is a liability protected vehicle that you can offer to your investors. The choice was made to make those passive. And that radically changed the industry. It basically shut off an avenue of flows into the traditional mutual fund and active manager space and narrowed it down to today. If you open up a new 401k, you'll typically see about 10 choices, all of which are a target date fund.
Do you know why they chose that?
I do.
Please tell us.
Oh. Because Vanguard outspends the rest of the industry in lobbying.
When they made that decision then.
Yeah.
I mean, I would argue, I mean, it's pretty, I don't know, forcing people to target date funds rather than sitting in cash in your 401k seems like a net benefit for most people who had otherwise no reason to actually choose a fund or didn't really know what they were doing. Like to the end investor, it seems like a net benefit. I guess your argument would be, as a whole, right, it's not necessarily good for, financial markets.
They also looked at the fact that 80% of the active managers weren't outperforming the benchmark anyway, right? So they could get cheaper exposure that seemed to be the best performing vehicle at the time, right?
But it seems even more the case today, right? I mean, one of the amazing things, and this will just highlight the ridiculousnly of some of the scenarios that come out of this. It's the same observation I had about small business investment, which has suffered in the past 25 years. Largely, I would argue, as a byproduct of the type of policy choices we make. Denmark, Sweden, and Norway are all considering converting to a US-style 401k system for their retirements. If they do this and they follow through on the recommendations that are being made, 99% of the retirement savings in countries like Denmark will be sent to the rest of the world. Right? This is literally your small Nebraska farm town and the disinvestment that occurs in those types of regions happening on a countrywide basis. Right? The simple reality is you do not optimize your investment systems in a country to maximize the value for the retirees. You have to recognize that what you're also taking is the accumulated earnings of the society itself, and those have to ultimately be redirected back into the society. Right, so unfortunately, this is actually spreading because of the perceived success of this, and again, lobbying plays a critical role. The idea that we should build our system simply for maximum performance, especially when that maximum performance becomes self-referential, is ultimately not a good thing.
So you think I think I'm hearing that you're saying for the Norwegians, it's almost bad for them to invest internationally, even though if they have a higher expected rate of performance because they should be giving back by investing locally?
There's a component of that. It's part of the recognition that one of the real challenges we have is that we have created a K-shaped economy where the K is largely defined by the fact that you're old and have therefore accumulated assets that have appreciated dramatically, right? It's also tied to how we build our retirement systems. Again, if the focus is on the equity value, the residual of that system as compared to what the cash flow that is generated from that system, you ultimately are creating a system in which you drive concentration of wealth.
So I'll go out on a limb and say we're not going to get a policy response from this anytime soon. I mean, I would make the argument that with the Trump accounts that we're talking about, $1,000 into, I think it's S&P 500 or something cheap passive funds, like we're going in literally the opposite direction. So my question to you would be like, what do you do to benefit or bet on this going this way or against it? Like, how do you invest? What's the way to invest to basically take advantage of this or bet against it?
Well, I think that there are opportunities that are created by this, and you were going to ask the question, is it just equity markets or is it fixed income markets as well? I'll give you a really, really simple example of how this is impacting fixed income markets. Right? Simply imagine there's only two bonds in a bond index, a 2-year bond and a 30-year bond. Right? Initially 50-50 between the two. The Federal Reserve hikes interest rates. What happens to the 2-year bond? It's totally fine, barely changes in price. What happens to the 30-year bond? Falls in price. The next dollar that comes in now buys a lot more 2s and a lot less 30s. Right? So this perception that we've lost control of the long end of the curve, et cetera, is simply wrong. What actually happened was we had unexpected interest rate changes that has structurally lowered the proportion of duration in bond indices. And as a result, we underinvest in the long end when we put money to work through passive indices. Right? The flip side happened in the period of 2009 to roughly 2020, in which we actually lowered interest rates. What's the most sensitive to that? The long duration, low coupon bond. They became very large components. The duration exposure of the bond indices rose to the highest on record going into 2021 hikes. Right? So the bloodbath that occurred in the bond indices was largely a byproduct of that increased duration exposure. Right? This has had a huge impact not just on our investments, but also on our policy, to go back to exactly that point. And I agree with you that the policy is unlikely to change. When I presented this work, by the way, to the Federal Reserve on the bond markets, part of the reaction was among the most terrifying things I've ever heard. Literally, I had researchers at the Fed say, wait, there's bond indices?
Serious?
Yes.
Well, the one thing I would say is here, like, one thing that you should be happy about, or theoretically, if this is your view, is like
Very few things I'm happy.
the ETF industry is heavily leaning towards more active approaches to things, way more active decisions. They're becoming tools for investing rather than what's happening. That said, most of the flows are still going to the passive stuff built in the 90s and early 2000s. That's where most of the money is going. So I guess to go to you, Dave, like, oh, you wanted to say something before I even finished.
No, please.
I was going to say, where's the ETF industry going with regard to passive here? Because from my point of view, it looks like there's a lot of new tools being built, some of which were on the stage right before us talking about this, where like they're not necessarily 100% just, simple passive flows. There's a lot more efficient, theoretical capital allocation happening with some passive vehicles or pseudo-passive vehicles.
Look, I think the question, there's two ways to look at this. If you think about like Mark Andreessen in, I don't know, 2011, 2012 said software is eating the world. I think the reality in the ETF industry is that ETFs are eating investment management, and that's partially reflected in the passive flows as well, right? So I think that's happening. But what I think you're also getting is an increasing number of new and innovative products in the ETF world that are helping people to become actually less and less passive while in their exposures while maintaining a core of passive exposure, right? They were, on the last panel, they were talking about return stacking. At Northern, we think about retirement more than accumulation. So like the decumulation stage is critical to all investors now, right? As the number of retirees and the boomers start to retire. So we think about it from a decumulation problem in that, yes, they've done well with passive, they've outperformed, and now they need to spend their money and figure out how to sort of decumulate. We think of that, we approach that through this creation of a product that we call distributing ladder ETFs, where if you think about like bond SMAs that you've put together for your clients, we have taken the ETF wrapper and applied it to a bond ladder SMA and we give you that in an ETF, a single click for a 30-year, basically SMA of munis or tips, right? And you can do it in a 5-year, a 10-year, a 20-year. Like that's the way we think about it, and you'll get your sort of investment income every year. And it looks exactly like an SMA, but it's wrapped in the ETF wrapper. I think that's what you're going to see here, right? Like people may, I think this sort of passive piece is sort of blurred for investors. What you've said is brilliant, the stuff you're talking about, Michael. I think it's hard for a lot of people to decipher and understand it, right? And that's generally the way it is when that comes. But what they're doing is they're adapting their portfolios to accommodate this behavior, is what I see. And by doing that, they're using more and more innovative products. And we're producing them for that reason.
And I would just emphasize that decumulation phase presumes that you can actually sell the securities that you've accumulated, right? You're now actually relying on those same vehicles that have benefited from the dollars flowing in. Did you give me cash? If so, then buy.
Well, you need money to spend, right? So in our case, it's bonds and they mature, so we give you your principal back on the maturities.
And so the really critical point that I would emphasize is that as more and more people ultimately enter into that decumulation phase, the risk that those flows reverse, and we find ourselves with something that looks much more like the XIV events of February 5th, 2018 for the entire S&P.
Well, look, the expectations for equities are lower. Like if you go across the bank expectations for equities for next year and the year after, right, they're dramatically lower.
They also were dramatically lower a decade ago.
So they're not necessarily always right.
Well, no, it's not even that they're not. It's not even that they're right. It's that it doesn't matter. Nobody actually is choosing to allocate on the basis of that. I'll just give you a really simple example. Vanguard will be the first person to, in their investment outlook, will say we expect the returns to equities to be low over the next decade. We expect the returns to bonds to be relatively high. Have they changed their target date fund allocations? No. In fact, Most target date funds are actually increasing their equity allocations, and we're hearing serious discussion around things like moving from a 60-40 to a 60-20-20. Nobody is thinking about 40-40-20, right? Because equities have actually delivered returns, and we sell largely on the basis of historical performance, while simultaneously saying past performance is no guarantee of future success.
All right. I guess I'll wrap up by saying, like, what do you think of the idea that, like, we're out of time, but I just, like, the S&P 500 just kind of has a monetary premium now in the way that it's being used in retirement portfolios. And I go back to the idea that, like, still stocks are drastically impacted by things like earnings and idiosyncratic risk. So active managers are still driving the ultimate price. I think maybe just the passive flows are kind of, kind of this tide underneath, but there's still waves and other things that can happen and change what's happening.
Yeah, so I agree with that, but again, remember that those waves are decreasing in amplitude relative to the tide, right? We've moved from a gentle tide on a Caribbean island to the Bay of Fundy.
Okay.
And nobody cares about the waves in the Bay of Fundy. They care about the tide level. So I actually very strongly disagree with your characterization of that. With 2 seconds left to go, I would simply point out that the idea that there is a Veblen good, the S&P 500, that we all have to have, we're actually starting to see that play through. One of the most important switches has actually happened over the past, give or take, 18 months, where I would argue that investors are increasingly, quote unquote, figuring out the game, right? The flows into the Vanguard Total Market Cap Index have begun to decline relative to the flows into the S&P 500. Why? Because small caps have underperformed, right? So what do they naturally do? They discard the small caps and they chase after them, right? Bonds have underperformed. What do? They discard the bonds and they chase after alternatives. Right, so there are opportunities that are emerging finally, but unfortunately what that tells you is that we're getting closer and closer to the strike of midnight.
On that positive note, we're going to wrap up.
Thank you.
Thank you.